So in this video, I'm going to be talking about the types of business costs, okay? And so we all know that businesses have to pay something. So when they earn their revenue, we'll talk about what revenue is. Okay, so basically what they need is they need to pay for those costs, such as rent or wages for their so I'm going to be talking about the types of costs. Okay, so when it comes to the types of business costs, okay, you have two types. Okay, so you have fixed costs and variable costs. Fixed costs are those that don't are those those costs that don't change don't change with the level of production or level of sales. So when I say production, it means the level of products being produced or product, and when I say level of sales, I mean the number of products being sold. Okay, an example of that is rent. Let's say we or I hire a factory, and I have to then now pay my cost. If production goes up, or if it goes down, I will still have to pay rent. So therefore, from the name, you guys know it is a fixed cost. Uh, So this over here is a fixed cost. Okay, now we move on to variable, and I guess you guys must know that by now that what variable costs are. Those costs that do change with the level of production. With the level of production or level of sales or level of sales. Okay, so let's say you have, or let's say that production goes up. Okay, let's say production goes up, and you, or the way you pay your labor the way you pay your labor is by using piece rate. Now piece rate is basically when you pay your labor, basically when labor is paid labor is paid per unit output. So the amount of output per unit output, so like the amount of output they make depends on how much or their wage. Okay, so if production increases, this means that the labor if labor stays the same, it means the labor has been working hard, and therefore it means that they have produced more units of output. So production is then therefore linked with output. Okay? And therefore this time, or for this specific period of time, these guys will be have to pay more, so the variable cost goes up. Okay, so therefore it depends. So variable costs, they're not stable, and fixed costs are also not stable. They're stable in the short run, stable in the short run. Okay, now when you add fixed costs and variable costs, you will get total costs. So these are like, this is like the ending or the total amount of money you have to pay to cover these costs. And these, the costs are over a specific time period, over a specific time period. Okay, so like let's say fixed costs were 10,000 and variable costs this time were 6,400. So sorry, 400. Then therefore total costs would be equal to, total cost would be equal to 16,400. Okay, now last type of cost, it is related with total costs and all the, so if we come to average costs. Average costs is basically, if you put it in a formula, it is basically total cost of production over total output. Okay, so and this is all over, again also all over a given period of time, a given period of time. Okay, so let's say you have the total cost of production over 1 month was, let's say, $7,000 or $70,000, and the total output of, let's say, shoes, pairs of shoes, not just like one shoe, I'm talking about pairs of shoes, was, let's say, let's make it 7,000. Okay, so then therefore what the average cost, or the, if you put average cost into another way, or another wording of it would be cost of making one output, and in this case one pair of shoes. So cost of making one pair of shoes was, you do some quick math, so these zeros get cancelled out, and 70 divided by 7 is basically 10. So the cost of making one pair of shoes was $10. Now what do businesses use all of this for? Okay, so they use it for three main reasons. They use it to, number one, to set prices of the product. Number two, deciding whether production should continue or not, whether production should continue or not. And lastly, location decisions. Okay, so for setting prices, why they do that is, let's say, decisions, I don't know how to spell decision, let's just write location. Okay, so location. Okay, so setting prices, let's say that, okay, we have a pair of shoes and its average cost is $10, therefore they will increase the price in order to gain profit, in order or to pay for all of the total costs for it next time. Okay, if they don't, then they are in a loss and they won't be able to pay for the cost. And let's say that the cost of producing each pair of shoe was humongous. Okay, so let's say that the cost of making one shoe was a lot, and the total output was really little, and when they sold the product, the revenue was very low. Revenue is the income from a product over a given period of time. So therefore they'll stop production because it's too expensive to make and revenue is low. And location, like which location is better, a location A or location B in terms of costs.